This is Successfully Retired with Hamilton Brandenburg. Today I am joined yet again with Austin Preece of Preece Financial Services. Welcome to the show, Austin.
Yeah, thanks for having me. Your listeners might be starting to get sick of me, but I'm always happy to be here.
It's okay. My grandmother called and said that she liked the sound of your voice. So,
Good.
You're,
Good. That's
listener
the only person.
approval ratings have been coming in strong.
Yeah, the only person we care about making happy is your grandma.
That's right. I've got a couple of attorneys who I work with closely on estate planning, and a lot of them also will do like a real estate practice. And I had an attorney call me who is working with an individual, and this individual was really looking at doing a rental property and a self-directed IRA. And so we kind of talked through some of the pros and cons of that, because I think that individual wanted some feedback, maybe some unbiased third-party feedback on some of the pros and cons of that. And I've run into it maybe twice in my career where a client has looked at wanting to purchase a rental property inside a self-directed IRA. Sometimes they have great feedback on it. Sometimes you can tell that there's some pitfalls that they didn't realize were out there. And now, Austin, you have, I mean, obviously you're a financial advisor like I am, but you also have a stronger accounting practice than I do. I do some tax preparation, but you've got accounting and bookkeeping, and you also offer like a big kind of core service, if I understand correctly, is you will do transactional one-time real estate evaluations for people who are real estate investors to help them make decisions around their properties, ownership, liquidity, things like that. I know that's not the point of our podcast, but can you kind of tell me what that offering looks like? Because you're kind of more real estate focused than I am.
Yeah, I am more real estate focused. I just really love the space. So what that offering is, I call it a real estate portfolio analysis, basically, like financial analysis of all of your rental properties to kind of see which ones are performing best based on the equity that you could get out of it if you sold it, and that's where a lot of people, I think, get mixed up on real estate, is they focus more on cash flow than the equity side of things and what that is doing for them. And that doesn't specifically relate to our conversation today, but I will say that one thing that does relate to our conversation today about it is that when I do these analyses, what I find is that a major driver of returns in real estate is leverage. So being able to take a mortgage out to purchase a rental property. And the reason that's such a big driver of returns is because your investment is smaller. So the returns that you get on that investment is they're higher because you have a smaller denominator, right?
If you put $50,000 down on a $300,000 property and your property is appreciating even in the ballpark of 5 or 6% a year, and you're paying down your mortgage, you're really getting to take advantage of, I mean, I don't want to sound like the people who are like the grifters on LinkedIn, but you're using other people's money to build your wealth, right? So it does allow that to compound pretty quickly, especially if you're cash flow positive and your tenants are essentially paying your mortgage for you. So all that to say, you were the first person. I was like, okay, I know just enough about doing this to be dangerous, but I'm gonna have a call with Austin, and we're gonna really kind of, I guess, pull back the layers on the onion, if we're gonna Shrekify that, and just talk about it. But before we get into the self-directed IRA process of purchasing homes, would it be okay with you if I just kind of spend some time picking your brain on the tax efficiency of investing in real estate in general?
So real estate is, great because you can get high returns, right? It's also great because of the potential tax efficiency that you can get from it. And I think the major piece of that is depreciation. So being able to, say you buy a $200,000 property, you get to, say the land is worth $50,000, the home that's on it is worth $150,000. You get to take a deduction against your profits on that rental property for, basically 3 or 4% of that $150,000 each year. So it's a really great way to kind of shelter some of the income that you're getting from taxes. And that's probably the biggest tax efficiency benefit, aside from, just the fact that we talked about appreciation briefly, and as that appreciation is happening, of course, you don't have to pay taxes on that either. So your returns are coming to you from cash flow, paying down the mortgage, and then appreciation, and you're only paying taxes on a portion of the cash flow that you're receiving from the property because of that depreciation deduction. So that's probably number one, the biggest thing. But another great piece about real estate is you can continue to defer taxes even if you sell a property. So with stocks, we can't really do that, right? You buy a stock for $100, it goes up to $200 5 years later, and you decide to sell it. You're going to pay taxes on that $100 of gain, pretty much no matter what, unless you have losses to offset it.
Funny story about that. I had a friend in college, we'll go unnamed, and he kind of got into like day trading and stuff, and he's still a friend, was a friend, but this is probably around college time, if I remember correctly. He was saying this, maybe just shortly thereafter, and he was telling me about like all the trades that he had done, and it was like a lot of trades. And I was like, man, and I told him, I was like, have fun at tax time reporting all those transactions. He's like, I thought it was like real estate, where if I sold something, as long as I reinvested it in something else, I didn't pay the taxes on it.
Right.
And I was like, no, that's not the case, man. I don't know what happened there. I didn't ask, but you pay the taxes as you go with stocks. When you're trading with real estate, you have the option of taking that property and kind of basically what do you call it? 1031ing it into the next property, right?
Yeah, it's called a 1031 exchange, right? So as long as you follow all the rules, of which there are many, and you can defer all of your taxes into the next property, or even sometimes like a more diversified, they're called Delaware Statutory Trusts, or DSTs, where you don't have to manage the property anymore, but you can defer it. And then if you hang on to it until you pass away and leave it to your heirs, you get a step up in basis. So really nobody could end up paying taxes on the gains or the depreciation that you took while you held the property. So
a really great way to pass down an inheritance. If you were looking at all things were equal and you had an IRA and this and that, and you wanted to leave some money to a church and some to your kids, there's a strong case to say, hey, leave your IRA to a charity or the nonprofit, and then leave that rental property to your kids, all other things being equal, because you've got to take 30 years of depreciation on this property, and you got basically all these great write-offs, which is huge. I had a client last year who is an accounting client, and they came to me. They were kind of self-preparing a tax return, and very popular software they were using as they're putting in their rental income, it wasn't even really giving them a very clear way where they could account for depreciation. And when we took the same information that they had and filed it correctly with the correct schedules and everything, the difference on their tax bill was thousands of dollars for just a middle class one rental property and a good salary investor. So the tax savings are huge if you're owning it outright, right? If you're taking that depreciation along the way.
Hey, I just have one more thing on the tax efficiency of real estate, and it's really just that it can also qualify for the QBI deduction, qualified business income deduction. So your profits, you might only pay tax on 80% of your taxable profits of your real estate effectively, because you'll get a deduction for 20% of your profits, because it can be viewed as a business in that sense. So it qualifies for that 20% QBI deduction. So those are three main things that are like really massive benefits to real estate. Great reasons to hold real estate just in a taxable sense outside of an IRA, because you're not going to get a ton of benefit from having it inside of an IRA, given how tax efficient it is outside of an IRA.
Yeah. So let's talk about that. First of all, why would somebody buy it in an IRA? Why do it that way? Because you have to get like a special custodian. I think maybe Schwab at one point in time had an option for self-directed IRAs, but a lot of places don't. You kind of have to go somewhere special and set this up. So why would you buy it in an IRA, and what are the pitfalls of doing that, or the things you need to consider?
Yeah, sure. So I guess first, Hamilton, do you want to go through a little bit of just what a self-directed IRA is? So that
I mean, we can do that. So I'll butcher this and then you can correct me. But
I'll butcher it too.
Yeah, IRA stands for individual retirement agreement, right? Which means, or arrangement, I think it is, which means that, pretty much anybody can set up an IRA. Now, obviously there's custodians like Fidelity and Schwab that do that for tracking and tax reporting, but you can open a self-directed IRA, meaning that and that opens up the doors to a lot of different, maybe like investment types that you couldn't get by calling up your stockbroker and saying, I want to do this. So you could buy maybe like physical gold. And I know that there's been like commercials on like, hey, buy these gold bars in a gold IRA. People use it to buy rental properties. I've heard people using like leases for commercial land, like weird things that I've never run into, probably won't in my career. But let's say you had a $1 million IRA at Fidelity or wherever, and you wanted to take advantage of the real estate market. You could open up a self-directed IRA at one of these companies, transfer, say $500,000 or whatever amount you want to that self-directed IRA. Now it's sitting there in cash, and you use that cash for your alternative investments.
Right. Yeah, exactly. So like in other words, you're not going to go to Charles Schwab or Fidelity and buy 123 Main Street in your hometown, right? Not possible. So a self-directed IRA kind of allows you to do that.
Not until the tokenization of everything kicks in, but
until the tokenization of everything kicks in. Yeah.
Leaving Pandora's box closed on that one right now.
Yeah. No kidding. Yeah, so self-directed IRAs allow you to do that. Self-directed IRAs also typically have more fees associated with them than just a regular run-of-the-mill IRA at, your regular custodian, whether it's Schwab, Fidelity, Altruist, or, Robinhood, whatever. So that's kind of pitfall number one. You got to make sure you're doing it with enough money to make it worth the extra fees that you're going to pay on a self-directed IRA. I'd say the biggest reason that someone might use an IRA to buy real estate directly is because they don't have taxable dollars to buy real estate with. Maybe they don't have the money outside of an IRA, but they do want to have access to real estate. You already mentioned there are other ways to do that with funds within IRAs. Personally, that's my preferred method for a couple of reasons. One, it's simpler. Two, you're not going to run into as many fees. And then there are the pitfalls around buying real estate in a self-directed IRA that we want to talk about too, right? So I think probably the biggest one there, aside from the fact that you're not benefiting from the tax efficiency of real estate by buying it within an IRA, is you can't work on the property. If you do work on the property that you own within your own IRA, it basically disqualifies your entire IRA. So what happens if you have $1 million IRA, 100,000 of it is invested in a rental property, and you go fix the sink once? $1 million taxable that year. It's not a good situation that anyone wants to be in.
No, I would say that's really, really big, because a lot of people who, I'm just trying to envision who normally does this. Okay. And I've only run into it a few times, but a lot of times it's not BlackRock buying investments. Okay. It's mom and pop who've got some money stashed away. And a lot of times dad's handy and he fixes the sink, or they're going to go paint a wall, or they're going to drop off something for the tenant. You know what I'm saying? You get involved. You cut the grass one time at your rental property that you own in your IRA. Now that IRA is disallowed by the IRS, and you have a big tax bill that's coming due. And of course you can play the game all day long of, well, how will the IRS find out? Well, that's just basically like saying, could I get away with breaking the law? Maybe you can, but if you can't, then that's kind of on you. At the end of the day.
You could compare this to a speeding ticket, right? Like if you got shot for speeding, that's kind of what this is like, right? Like if you speed and you get a ticket, you have to pay a few $100. Well, what are the chances they're going to catch me for going 28 and a 25? Pretty low, but you don't want them to shoot you, right?
Exactly.
The consequences are too big, I think, to really be okay with taking that risk.
So you have to be using a property manager. You have to be using somebody else to take care of every single aspect of this rental property. It's not a big deal for everybody.
Right.
Another thing that I think you'll probably hit on is no personal use of the property is
Right.
allowed at all. And to my understanding, that means you personally, your family members, so you can't buy this house and lease it to your son or your son-in-law, the way I understand.
Yep.
You stay one night in this property, and especially like if people are doing it for long-term rentals, you probably wouldn't see that as much unless
Right.
they are kind of like, well, let's lease this to my kid. But like Airbnb situations, you get a sweet beach house at Destin. Like, sorry, dude, you're not going there. Your family's not going there. This is you got to lock that down because otherwise, again, disallowed. This is starting to feel like the Parks and Recreation episodes, straight to jail.
Another reason that real estate can be such a great returning asset is if you do some of the work yourself and you're not paying out of pocket for someone else to,
Sure.
fix the sink or mow the lawn, right? So that's yet another thing that you lose about
Yep.
real estate being a good investment when you put it inside of an IRA.
Well, that's a good point too, because you talk about doing the work. So not only do you have to pay somebody else to do the work, but you also have to pay for that work to be done with IRA funds, right? So you've got the self-directed IRA with a checkbook probably, but all rent that is received has to go into the IRA. Every single expense to pay for anything has to come out of the IRA. There's no exceptions to that. So that could also create a problem for a lot of people, I feel like.
Yeah. Yeah. And so you run into the situation of, well, shoot, what if I don't have enough money in my IRA to fund a big repair that needs to happen? Insurance won't cover, the basement flooding or something like that. And you have a $20,000 repair that needs to happen. I don't know. I'm just making stuff up, but these are risks that you don't have when you're not holding it within an IRA, right?
So, I mean, the point of that being, like, if you have a $500,000 IRA, don't turn around and buy a $450,000 rental property inside of that, because your margins are really, really, really tight there. And God, I wouldn't be able to sleep at night, right?
Yeah, exactly. And what you just said there kind of hits on another big piece of it, which is you typically do not, it's not that you can't, but you typically do not want to use leverage when you're buying real estate in an IRA. So you typically don't want to use a mortgage. And the reason for that is it can create what's called unrelated business income taxes, or UBIT. So if you're using, say you buy that $500,000 property, you put $100,000 down from your IRA to purchase the property, and you have a $400,000 mortgage. 80% of your profits are going to wind up being taxable, even though you hold the property in your IRA, right? So
you're in a situation here. What you're telling me is you're in a situation. You could be in a situation where, if you're using a mortgage for a portion of it, you have a your property is owned in a quote unquote tax deferred vehicle, and you're essentially, like, I'm just thinking about, like, in layman's terms, like, you're essentially paying taxes on the dividends of an investment inside of a tax sheltered vehicle on a portion of it. Some of that income you're paying taxes on it. So not only are you losing the fact you can't write off depreciation and your expenses, you get no write-offs, and if you use leverage, you're potentially also paying taxes out of pocket. Oh, and by the way, you probably can't really benefit, especially if you're under 59 and a half, you can't really very effectively benefit from, like, the cash flow of it, because the rent has to go into the IRA.
Exactly. Yeah. Yeah. So, and as I mentioned early on, when I'm doing those rental portfolio analyses where I'm looking at people's rental properties, the higher returns come from the properties that have higher leverage. If your real estate can provide really great returns, if you do not use any leverage at all, we start to see expected returns approach around what the stock market can get you. So you're looking at, if it's a good property, low double digits. If it's not a great property, high single digits. It's kind of what we're looking at. So all of a sudden, we took this asset that can be a really high performer. Really provide a lot of returns for the investor, and we limited ourselves in how we can use it and now we can't get those high returns anymore. Or if we do, we're using a tax deferred account on something that we have to end up paying taxes on because we used leverage, right? So it's pretty inefficient.
One thing that I'm seeing some pieces come together here. So we talked about just owning real estate in general can be a really great inheritance tool because you got 30 years of depreciation that you wrote off against your taxes. So win. And then you passed away and you leave this to your son, your grandson, whatever, and he inherits it, and he's getting it at the value that it was the day you died.
Yeah.
So even if he turns around and sells it pretty quickly, he probably doesn't have to pay almost anything in capital gains, or at least very, very low, right? Unless like just in a realistic scenario. That's all gone when you put it in an IRA. Now, since the Secure Act 2.0, you're a non-spouse inheriting an IRA unless there's an exception, like you're a minor or you're disabled. There's a few other little things. You've got 10 years that you have to have the whole thing, the IRA liquidated.
Yeah.
Those required distributions, if I understand it correctly, have to happen in years 1 through 9 as well. Some amount has to be coming out. And if a lot of the
who passed away is already taking RMDs, I think is the
yes, thank you.
Mm-hmm.
Yeah, I'm a little fuzzy on that one. So there's scenarios where you're going to probably have to be taking out already, and you've got a big illiquid asset that needs to be sold if you don't have other things in there to satisfy the RMDs. But it definitely has to be sold by the 10th year because you gotta close the thing out, right? And then when you do that, all that money that you're taking through a distribution is coming to you at whatever your highest marginal tax bracket is for ordinary income, which people listening to this hopefully by now would know. When you hear ordinary income, think like least favorable tax treatment, or at least like very not favorable, right? So that you lose all the benefits of depreciation and getting it at long-term capital gains rates for next to nothing. You're basically losing all your efficiency to taxes.
Right. Exactly. Yeah. So those are the main reasons pretty much whenever someone asks about it, I say, I wouldn't do it. I don't think it's worth the hassle. There are ways that we can get you alternative exposure in just a regular IRA, right? Oh,
I almost think it would make more sense for most people if you got $500,000 in an IRA and you wanted to do this, pull out $30,000 and pay the taxes and penalties and just go put that down and get a mortgage on a rental property. Like, I'm not saying like that's still really expensive. That $30,000 could end up actually being $60,000 worth of liquidations to get you $30,000 if you're in a really high tax bracket. But at the end of the day, you just avoid a bajillion bombshells. You can use this. You can work on it yourself. You can use leverage. Your heirs get a stepped up cost basis. Another thing we didn't talk about is you're going to have to probably get annual appraisals done on your property. At least I don't know about I don't know the rules about when you're younger, but definitely for when you're 75 and older, when you're having to take mandatory distributions, you have to take a distribution based on your life factor and the value of your IRA at the end of the previous year. And so that you got to pay $300 or whatever it costs every year to get an official appraisal done. So again, that doesn't mean that's not the whole reason why you shouldn't do it, but it becomes it's almost like just take $50,000 out of your IRA, put it down, and do that, and save yourself a lot of headache.
Yeah, and we should add, I know we want to talk about some alternatives. What might you do in your IRA instead? But we should add, we've been talking about it as though it's always going to be a traditional IRA where it's taxable upon the withdrawal.
That's a good point.
It is possible to do a self-directed Roth IRA, but for the reasons that we talked about, you lose a lot of the returns when you don't use leverage on rental property.
And if nothing else, you're losing a lot of flexibility with just being able to use it, especially if it is a short-term rental, Airbnb type rental. Right. You're just giving all that up, or you're having to be honest with lying, which I'm not signing that return, right?
Yeah, same here, right? Yeah. So if you're hell bent on, can I? Is your grandma going to be okay with that? Sorry, Hamilton, I swore.
Yeah, that's okay.
Okay, all right.
grandma doesn't mind that one too much. You're good.
Perfect. All right. So if you really feel the need to invest in real estate through a self-directed IRA, personally, I might look at something like farmland. Where you don't have the costs, the repairs costs that you're going to have on a rental property. You're not losing really anything to depreciation because there's no improvement necessarily on the property. So if you really feel like you have to do it, then that might be a way to do it. Of course, I live in Wisconsin. There's a lot of farmland up here,
We've got some tree farms in the Southeast. That's what we have. You drive through like South Carolina and Georgia and like the rural areas, and you just see like baby pines from where they got cleared 10 years ago. So,
nice.
But then again, I guess, and make sure you're not chopping the trees down yourself or going for a walk in the woods.
And that's the thing, right? You're renting the property to someone else, right? And
so that definitely could make sense for a lot of people to do that.
Right. It would be I guess the one way that I would say, that I guess that could make sense,
Well, and I think too, like, and I was thinking a lot about this. If you're like the guy, maybe you own the car dealership in rural Georgia and you have $5 million in your IRA and you have all these cash flow and you're really wealthy and you want to buy this tree farm and you do it in your IRA. Okay, maybe that makes sense. But like for regular middle class, upper middle class, working Americans who had like a 401k and they roll it to an IRA, like this is one of the things I think is the scariest of it to me is like, okay, let's say you had $1 million in your IRA, you put half of it into a rental property or even just 200,000. That's 200,000 you're putting into one single investment. And I'm not saying you're not putting $200,000 into Apple stock. You're putting $200,000 into one building that Apple owns in a certain place, right? That's the level of your concentration of your investment. And I don't know about you, but I know myself well enough to know that like I can't pick properties like the best property that effectively. I'm going to be biased by the fact that like this is the area I live in, this is the kind of business that I know, and all these other things are going to cloud my judgment where I'm going to end up putting a fifth of my net worth into one physical thing that really may or may not even be the best thing for me to have. And it comes with a lot of strings attached.
Yeah. That's a great point. You definitely want to try to be diversified. And, I guess like for a lot of people who might be thinking about this, they're probably, either already real estate investors or they know a bunch of real estate investors. So one of the ways that you can get real estate access without necessarily owning the real estate is by providing loans to people who are buying real estate. So that's another thing that you can do with your self-directed IRA if you're going to set one up. And you provide a loan. Maybe it's like a second. It's not the primary mortgage, and so you're charging a higher interest on that. That interest is then deferred because it's in your IRA, and you're not losing any tax benefits because that interest isn't tax advantaged in any way anyway. So that's something that I've seen that I think works a little bit better. But again, that is something where if you want to invest in private credit, you can find ways to do it without making the deals yourself, without hiring an attorney to figure all that out. So I don't know. There are just all sorts of other alternative opportunities that I would look at first, I guess.
I feel like the kind of person who should do this is the kind of person who likes to play really complicated board games. And the thing that they enjoy out of it is they like to find really obscure rules to stick everybody else with and be like, no, you forgot about like this commander card does. And then boom. Like if you're into that, then you're going to love this.
That's my father-in-law.
Okay, that's my brother. He has like a version of Risk that we like to play, and it's 5 hours long, and it has all kinds of rules. And usually somebody gets their feelings hurt. Usually it's them. But it's like, okay, this is not something that the average person would probably enjoy as much as they think they would, and they just need to. It's not that they shouldn't do it; they need to think really, really carefully about what their life's going to be like with all these limitations, and be okay with that.
Yeah, for sure. I work with quite a few real estate investors, so that should tell you how uncommon it is, right? And one of them did it successfully. All of his investments are real estate, and so he doesn't have any other investment. He doesn't work with me because I would tell him he needs to diversify, right? But the other person tripped up the rule about not working on your own property. There was self-dealing, and it created a tax liability for the entire IRA, which was $300,000 or $400,000 at that time.
My God.
So of the two that I've met, one of them did it successfully. that it's not a large sample size, but it is a risky business to be taking part in.
So that's a really important distinction, and we're going to wrap it up. But when you say the IRA, if I understand this correctly, you can correct me if I'm wrong. When the IRS looks at your IRA, they're looking at the aggregate balance of all the individual retirement arrangements you have. So that means if you had $1 million at an IRA at Schwab or Fidelity, and you had a $200,000 in a self-directed IRA somewhere else, then you do something wrong with the self-directed IRA, they don't care that you have different custodians. Your IRA is your IRA. It's everything. It's all of your IRA becomes disallowed. Is that what the word you used?
That's my understanding is IRAs are IRAs. 401ks and 403bs are different, right? So like if you have 500 in a 401k, 500 in an IRA at Schwab, and 200 in a rental property, and you do something wrong with the rental property, thank goodness it's only $700,000 in taxable income that year, right?
Yeah, that's right. That's right.
From the disallowed IRA. So that's a good distinction just for people to understand. But yeah, my understanding is all of your IRAs are viewed as one IRA.
Well, good stuff. This has been a great talk. I appreciate it. In the meantime, anybody wants to learn more about Austin's practice or about real estate investing and his real estate analysis, check out PreeceFP.com. Is that your website now, Austin?
Yeah, that's my website. Yeah, and I'm also active on LinkedIn. As you know, that's where we met. So yeah, you can reach out there.
That's right. Too. Well, thank you for lending your expertise, man. This has been great.
Yeah, thank you, Hamilton.
Thanks. This show reflects the personal opinions and viewpoints of myself, Hamilton Brandenburg, and my guests. Opinions and viewpoints are subject to change at any time without notice. No representation is made as to the accuracy, completeness, or relevance of the information presented. The information discussed is general in nature and does not constitute investment, tax, or legal advice, so consult with your tax, legal, and financial professionals about your specific situation. Past performance does not indicate future returns, and any indices mentioned are for reference and cannot be invested in directly. Brandenburg Financial Services is a DBA of CS Planning, an SEC-registered investment advisor.